Hello, friends. Very divine and serene greetings of this beautiful evening to all of you. I, Kunal Nagpal, am feeling immensely blessed and humbled to present this great economic session to you amazing people. Dear friends, the actual wealth being possessed by the entire Indian subcontinent is actually a moment of great pride for all of us because in the current scenario of the very gloomy global economic environment, we are so wealthy as being demonstrated by the current status of the statistical analytical reports as being presented by the eminent leaders across the international forum as well as the domestic forum. The picture being presented by them about the Indian economy is so divine and positive. The facts are so inspiring that that entire detailed analysis will help us to understand the true picture where we are actually lying, and we should actually be proud of our great eternal wealth. So, without any further delay, I would like to discuss the broad aspects of the overall dynamics of the Indian economy. And also, we will be discussing certain very important aspects and very positive news about the Asian region. That is, inflation in most Asian economies to be the comfort zone by mid-2023 as per Morgan Stanley. Inflation is likely to return to their respective central banks' comfort zone in 90% of the economies in Asia by mid-2023. Morgan Stanley said on Saturday, that is on 7th January 2023, that is today, adding that a number of factors are also pointing towards an even faster pace of disinflation. In a report titled Asia Economics, Asia Pacific, The Viewpoint, Rapid Disinflation and Growth Outperformance, the multinational investment firm said the possible return of inflation to the comfort zone will actually lead to the pausing of monetary policy tightening by the central banks. The central banks across the world have raised the interest rates so as to contain the rising inflation. 2023 will be a year of rapid disinflation. Inflation returns to the comfort zone for 90% of the region by mid-2023, allowing the central banks to pause tightening in the first quarter of 2023, that is January to March. Winning the inflation battle means Asia's domestic demand will be protected, allowing the growth to outperform, Morgan Stanley said. The global food and energy prices have retreated to the levels that are below where they were prior to the Russia-Ukraine conflict. On a year-on-year basis, the global commodity prices are in the negative territory and a significant disinflationary impulse is looming. The headline inflation has already peaked in 9 out of 12 economies, while core inflation has peaked in 6 out of 12 economies, the report said. We have long held a more benign view on the inflation outlook than the consensus. Our perspective is that Asia's inflation is more cost-push in nature. The labor market dynamics have not been distorted by the pandemic-era policies, nor are they overheating, it further said, adding that, which implies that the demand pull inflationary pressures are less likely to emerge. Further, on the concerns of investors that China's reopening will lift inflation in China and spill over to other parts of Asia, Morgan Stanley said inflationary effects would be rather muted. At the starting point, China's labor market is actually quite weak. We expect the labor participation to rise alongside the labor demand. Moreover, the weak industrial activity due to the sluggish exports An expected counter-cyclical slowdown in infrastructure spending will constrain the rise in commodity demand and prices, even as the drag from property activity will reduce, it said. So after this great analytical and very well articulated write-up by Morgan Stanley on the aspect of inflation in most Asian economies, which he is actually expecting to be in the comfort zone by mid-2023. This entire write-up is so well articulated, presenting an in-depth analysis. Also, I would like to talk about the growth prospects of India's economy, which is likely to be around 7% in the financial year 2023, as per the first advanced estimates. India's economy is likely to grow 7% in the current fiscal year, marginally higher than some recent independent estimates, according to the first official numbers for the period released on Friday, that is on 6th January 2023. Both Reserve Bank of India and the International Monetary Fund, that is the IMF, have forecast 6.8% growth in the financial year 2023, while the World Bank has pegged it at 6.9%. The gross domestic product had grown 8.7% in the financial year 2022, boosted by the pandemic-induced low base of the financial year 2021. The nominal GDP growth, without adjusting for inflation, is seen at 15.4% in the financial year 2023, sharply higher than the 11.1% assumed in the budget, according to the first advanced estimates released by the National Statistical Office, that is NSO. So if the absolute fiscal deficit will be, as projected, at 16.6 lakh crore rupees, the higher growth will depress the gap to 6.1% of GDP in the financial year 2023, compared with the 6.4% estimated in the budget. This suggests that despite the global headwinds and continued geopolitical uncertainty or friction caused by the Russia-Ukraine conflict, the recovery is on track, though there are pressure points, said Mr. Sunil Kumar Sinha, principal economist at India Ratings and Research. The gross value added is actually expected to rise 6.7% slower than the 8.1% growth seen in the financial year 2022. Now let's present the great statistical analytical report for this particular aspect. The GDP growth in the financial year 2019 was 6.5%, followed with 3.7% in the year 2020, minus 6.6% in the year 2021, 8.7% in the financial year 2022, and it is expected to be 7% in the financial year 2023. So what are the key takeaways? Sharp slowdown in the second half growth to 4.5% from 9.7%. The government gets the fiscal room to meet the deficit target. And if we talk about the percentage real growth for services, investments recover and industry drags. In terms of agriculture, in the financial year 2022, the agricultural growth, the real growth, is actually 3%, which is supposed to be increased, which is expected to be increased to 3.5%. For the mining and quarrying, in the financial year 2022, it was 11.5%, which is supposed to be 2.4% in the year 2023. For manufacturing, it's 9.9% in the year 2022 and 1.6% in the year 2023. For electricity, 7.5% in 2022 and 9% in the financial year 2023. For construction, 11.5% to be reduced to 9.1% in the year 2023. For trade, hotels, etc., it's 11.1% in 2022, which is expected to be 13.7% in the year 2023. For finance, real estate, it was 4.2% in the year 2022, which is expected to get increased to 6.4% in the current year. Then, for the public administration, it was 12.6% in the year 2022, and now it is expected to decrease to 7.9% in the current year. For private consumption, 7.9% in 2022 and 7.7% in the year 2023. Gross fixed capital, 15.8% in the year 2022 and 11.5% in the current year, that is 2023. And exports, 24.3% in the year 2022, which is expected to get halved to 12.6% in the current year. So, talking about the industrial sectors, on the expenditure side, private consumption 7.7% and investments as measured by the gross fixed capital formation, that is 11.5%, are seen supporting growth, while the global slowdown will actually curb net exports, denting the overall GDP growth. The investment rate is actually expected to rise to 29.2% of the GDP from 28.6% in the financial year 2022 and 26.6% in the financial year 2021. Among the supply side measures, strong post-pandemic recovery in the services, that is 9.1%, will likely boost growth, while manufacturing, that is 1.6%, remains muted, dragging down the overall industrial sector to 4.1%. Among the industrial sectors, construction is actually expected to grow the strongest at 9.1% in the financial year 2023, while mining will only see 2.4% rise in the gross value added from a year earlier. The data indicates almost all sectors have recovered and well above the pre-pandemic level, said Ms. Soumya Kanti Ghosh, Group Chief Economic Advisor, SBI. ICRA Chief Economist Ms. Aditi Nair said, "We believe that the buoyant albeit mixed domestic consumption should help to stave off some of the pain arising from the weak exports during this period." As the National Statistical Office pointed out, these are early projections based largely on the data up to November. They could see substantial revision, especially given the uncertainty over exports because of the faltering global economy. At the projected rate, India will be among the fastest growing major economies, just behind Saudi Arabia, which is seen expanding by 7.6% in the year 2022. For the 4-year ended financial year 2022, the GDP estimates have been revised downwards on 3 occasions, with average revision of around 80 basis points, Ghosh said. Also, this is the first time that the Reserve Bank of India GDP estimates are lower than the National Statistical Office. Now, in terms of the second quarter slowdown, the first advance estimates suggest a growth slowdown in the second half to 4.5% from 9.7% in the first 6 months. So the overall reduction in the GDP estimate is actually anticipated in the second half of the current year due to the base effect as well as the adverse impact of the slowing global growth. Ratings agency CRISIL said in a note, The slowdown is actually expected to intensify next year as the global growth falls further. Agriculture, construction, and electricity are among those expected to slow in the second half, according to the estimates. The Reserve Bank of India has forecast 4.4% and 4.2% growth in the quarter 3 and quarter 4 of the financial year 2023, respectively. Now, as far as the fiscal room is concerned, the higher nominal GDP will give the government fiscal room to step up spending or show a lower than budgeted fiscal deficit. The upward revision in the nominal GDP has given the government scope to increase the fiscal deficit by 97,080 crore rupees while sticking to the budget target of the fiscal deficit at 6.4% of the GDP, Chrysler said. The government is actually expected to meet the fiscal deficit target for the year despite higher spending on food and fertilizer subsidies helped by robust growth in tax collections. On the whole, these numbers are actually good for the government when formulating the budget, said Madan Sabnawis, Chief Economist, Bank of Baroda. So the overall financial year 2024 outlook is as follows. The economists expect the GDP growth to slow down further in the next fiscal year, that is the financial year 2024. While the government will continue its focus on capital spending, the main challenge will be a durable pickup in the private investment amid rising borrowing cost, demand uncertainty, and global slowdown, said Ms. Rajni Sinha, Chief Economist, Care Ratings, pegging financial year 2024 growth at 6.1%. I repeat, while the government will continue its focus on capital spending, the main challenge will be a durable pickup in the private investment amid rising borrowing costs, demand uncertainty, and global slowdown, said Ms. Rajni Sinha, Chief Economist, Care Ratings, pegging financial year 2024 growth at 6.1%. Ms. Sinha said the current consumer demand is actually skewed in favor of the goods and services consumed largely by the households in the upper income bracket, and broad-based consumption recovery is still some distance away. Chrysler expects the fiscal year 2024 growth at 6%. So after this detailed analysis of the growth prospects in the Indian economy, I would like to move towards another important aspect, that is the main projection by our respected minister, Mr. Piyush Goyal, that is infra, semiconductor, and domestic manufacturing are some of the strategic priority sectors for the current year. The Union Commerce and Industry Minister, Mr. Piyush Goyal, on Saturday, that is today, 7th January 2023, expressed confidence that the structural reforms taken by the government in the last 8 years will actually help India emerge among the top 3 developed economies in the world. In his address at the 27th edition of the Wharton India Economic Forum held virtually with the theme of India leading innovation in the age of uncertainty, Goyal, citing the most impactful economic reforms that will pave the way for India's growth story in the coming years, said a lot of structural changes that have taken place in the last 8 years have had a significant impact on the way the Indian economy is poised to take off. Terming GST as one of the important reforms, he highlighted that despite the challenging global scenario, the recent GST collections have been very robust. He also noted that India is now a more honest, transparent economy and people are now getting used to paying their taxes. He said, Insolvency and Bankruptcy Code, that is IBC, is also an important reform measure that has resulted in the robust banking systems in India. These banks have been able to provide the resources for the industry to grow. He also mentioned the reforms such as privatization, digitization of the economy, particularly the financial sector, then the decriminalization of laws and simplification of the compliances to enable ease of doing business. Responding to a question of which sectors are actually the strategic priorities for the government, Mr. Goyal said that infrastructure, semiconductor, and domestic manufacturing are some of the key priority sectors. He also pointed out that the respected Prime Minister Shri Narendra Modi ji's focus is on building a robust infrastructure in India. Private sector is also contributing in this particular endeavor. The minister said semiconductor is a critical sector for the Indian economy, and so is domestic manufacturing. And the government has introduced the production-linked incentive schemes to kickstart the Indian manufacturing in over 14 sectors. So, sharing his views on the current geopolitical environment in relation to the tensions between Russia and the West, Mr. Goyal reiterated the Prime Minister's belief that today's era must not be an era of war. On India's renewed focus in signing the free trade agreements in the past 5 years, the minister emphasized that India today has emerged out of the shadows of the past and has recognized that multilateral engagements often lead to economic partnerships which may not be in the best interests of all the stakeholders. Now, dear friends, we are going to discuss the key aspects as presented by the RBI Governor, Dr. Shaktikant Das, that India and neighbors are actually in talks for the cross-border rupee trade. The RBI Governor, Dr. Shaktikant Das, has said the central bank is actually in talks with the South Asian countries for the cross-border trade in rupees, that is the INR. The RBI is also looking to reduce the cost of the cross-border remittances by linking them with the unified payments interface. So, delivering the keynote address at the IMF conference in Delhi, Dr. Das said that the central bank digital currency, the CBDC, where the Reserve Bank of India has moved forward, can be an area for greater cooperation in future. In his speech, the governor highlighted the risks of high inflation and debt in the region. The IMF conference was on the current macroeconomic challenges faced by South Asia. The other initiative, together with the government, is the rupee settlement of international trade. We are already in discussion with some of the countries in this region and to facilitate rupee settlement of cross-border trade in the South Asian region, Dr. Das said. Multiple external shocks in the form of COVID-related global supply chain disruptions, food and energy crisis following the war in Ukraine, and financial market volatility arising from the aggressive monetary policy tightening have actually exerted sustained price pressures in the South Asian economies, said Dr. Das. He added that in the first 3 quarters of 2022, food price inflation in South Asia averaged more than 20%. So, prioritizing price stability may actually therefore be the optimal policy choice in the current context for the region, said Dr. Das. He added that while sustained and broad-based economic recovery remains the current policy focus, it is actually quite necessary to undertake the deep structural reforms to raise the potential growth trajectories of the economies in the South Asian region. On debt, Dr. Das said that the surge in external debt in recent years and associated vulnerabilities have actually undermined macroeconomic stability in several countries of the South Asian region. This is attenuated by the fact that there has been a shift in the creditor base from the Paris Club countries to the private lenders. The Paris Club comprises the representatives of advanced economies who have come together to provide debt relief to the poorer countries. The increasing reliance on the private creditors has raised the debt servicing costs and complicated the creditor coordination in debt resolution efforts. During 2010 to 2021, the average maturity on loans from the private creditors was 12 years as compared with 26 years for the loans from the official creditors, and the average interest rate on the loans from the private creditors was 5% vis-a-vis 2% on the loans from official creditors, Dr. Das said. Now, my dear friends, I would like to throw some light on the IMF projections who sees India as a bright spot. It says the reforms will actually spur the growth. India is actually the relative bright spot in the world economy, and further implementation of reforms would help unlock its growth potential, a top International Monetary Fund official said on Friday, that is on 6th January 2023. India is a relative bright spot in the world economy today, growing at the rates significantly above its peer average. IMF Deputy Managing Director Antoinette Tsai said at a book release function here. Tsai said, India needs to leverage its existing strength in services exports and extend it to the job-rich manufacturing exports by deepening its global value chain participation and complementary structural reforms that can actually boost productivity, formal employment, and exports. Doing so would actually create a vicious cycle and a virtuous cycle of productivity growth and strong export performance, she said. International Monetary Fund has actually forecast 6.8% growth for India in the financial year 2023, which is projected to slow to 6.1% in the financial year 2024. Tsai said macroeconomic policies were responding to the significant headwinds, with the fiscal policy measures supporting the vulnerable groups and the monetary policy addressing persistently high inflation. She pointed out that the country's world-class digital public infrastructure was actually facilitating innovation, productivity improvements, and access to the public and financial services in India. India is making important progress on its structural reform agenda, and further implementation of the reforms would actually help unlock its growth potential, she said. And addressing the media separately, she said the country will need to be more ambitious on the revenue side and look at the overall simplification of goods and services tax and income tax and provide a clearer path on fiscal consolidation. The IMF, in its Article 4 consultation report released last month, cautioned that India's fiscal space was at risk and called for a more ambitious and well-communicated consolidation to ensure medium-term fiscal sustainability. Tsai, addressing the event, said trade and investment reforms by reducing the tariffs and non-tariff barriers for both goods and in particular high-value services such as professional services will actually be pivotal in raising the overall competitiveness and establishing the regional supply chains to benefit South Asia. She said the disruptions to the key industries in the rest of Asia provided opportunities for the South Asia as the global value chains realign. But she said to benefit from these developments, the region needs to put in place the necessary structural conditions through further liberalization and regulatory reforms. She also cautioned against the geo-economic fragmentation. We see the number of trade restrictions rising and the sectoral composition of trade restrictions has been shifting. Asia has gained a lot from openness and integration, and we hope for strong international cooperation in order to avoid fragmentation. Ms. Tsai said, over the past 2 decades, extreme poverty declined from 500 million to fewer than 250 million people in Bangladesh, Bhutan, India, the Maldives, Nepal, and Sri Lanka. But now, poverty reduction cannot be taken for granted and is instead the result of the policy choices. So what are the key highlights? Unlocking growth. The International Monetary Fund official says India needs to pursue the reforms to unlock the growth potential. Moreover, India needs to leverage its strength in the services exports. Also, it needs to deepen the global value chain participation. So, what are the IMF growth projection for India? In the financial year 2023, it is expected to be 6.8%, and in the financial year 2024, it is expected to be 6.1%. So this is really fantastic, as it has been very well articulated, the overall in-depth analysis about the IMF projections regarding the overall growth prospects for the Indian economy, which actually visualizes India to be a bright spot in the gloomy global economic environment and says reforms will actually spur growth. And IMF has forecast a 6.8% growth for India in the financial year 2023, which is projected to slow to 6.1% in the financial year 2024. So now, my dear friends, I would like to present certain facts about the luxury car sales growth, which outpaces the broader industry. The sales of the luxury passenger vehicles grew faster than the local automobile market last year, nearing the pre-pandemic level, on the back of a quick economic revival and reaffirming India's credentials as the world's fastest growing major economy at a time when much of the West is actually beset with the recessionary risks. The sales of the luxury passenger vehicles grew faster than the local automobile market last year, nearing the pre-pandemic peak on the back of a quick economic revival and reaffirming India's credentials as the world's fastest growing major economy at a time when much of the West is actually beset with recessionary risks. As per the industry estimates, about 37 to 38,000 luxury vehicles were sold in India in 2022, an increase of around 50% from the year before, but missing the all-time high of around 40,000 units in 2018. The sales in the mainstream segment grew 23% to 3.79 million units last year, with vehicles priced upwards of 10 lakh rupees accounting for 41% of its volume. Within the luxury segment too, the demand strengthened for the pricier vehicles or the models priced above 1 crore rupees, supported by higher disposable incomes, said the senior industry executives. The top three luxury automobile manufacturers, Mercedes-Benz, BMW, and Audi, all posted strong growth. For Mercedes-Benz and BMW, the 2022 sales were their highest on record. Volvo, Lexus, and Jaguar Land Rover are the other major brands in the Indian market. We posted our best ever sales to increase our share in the domestic luxury vehicle segment last year, said Santosh Iyer, Managing Director at Mercedes-Benz India, that sold 15,822 vehicles in 2022. The sales last year topped the German automaker's previous record high of 15,538 units in India in 2018 and were 41% higher than the 2021 volume. During the year, it held more than half the market share for the luxury vehicles. Mercedes-Benz currently has pending orders for 6,000 vehicles in India with a waiting period of over 4 to 9 months. A healthy revival in the economy coupled with strong corporate earnings supported demand, especially at the higher end of the segment, drove sales, Mr. Iyer said. We have actually seen phenomenal growth, with sales at the top end growing by 69% last year. We expect the momentum to continue and grow sales in the double digits in the ongoing calendar year, that is 2023. Also, the luxury car buyer is getting younger in India. At Mercedes-Benz, the average age of the S-Class customer is now 38 years, while that of the C-Class buyer is 35 years, compared with 45 years half a decade ago. The participation of the salaried professionals and female buyers too has been increasing. They accounted for 12% and 15% of sales respectively in 2022, compared with under 5% for both groups 5 years ago. Iyer, who spoke on the sidelines of the launch of the Mercedes-Benz AMG E53 cabriolet priced at 1.3 crore rupees, which is the ex-showroom price, said the company has basically scheduled 10 new models for the launch in 2023, even as it is trying to increase the production and reduce the waiting period for the customers to 2 to 3 months in the near term. At BMW India, the sales rose 35% in the year 2022 when it sold a record 11,981 cars. The potential for the luxury car makers in India is actually promising, given that it is among the countries with the highest number of billionaires, but the share of luxury vehicles in the automobile market at under 2% is actually among the lowest among the major economies, said Mr. Vikram Pava, BMW Group India's president, told ET in a recent interaction. Audi India's sales rose 27% to 4,187 units in the year 2022. Mr. Balbir Singh Dhillon, its country head, is actually quite confident of a strong performance in the coming months on the strength of its portfolio, including for its performance and luxury cars, which are electric in nature. So dear friends, what are the key takeaways? The luxury lead. The Indian consumers bought 4 luxury vehicles every hour last year. The healthy economic revival, strong corporate earnings supporting the sales. Demand, especially strong at the top end of the luxury car market for the performance brands and electric cars. Young customers, salaried professionals, women buyers showing increased contribution to the sales, say industry veterans. So dear friends, I find this write-up extremely insightful with an in-depth analysis helping us to draw key insights about the luxury car dynamics in the Indian economy as its sales growth outpaces the broader industry. So, dear friends, I would like to conclude my session here itself, and I think that you have been benefited immensely with this great productive session as we have discussed various broad dynamics of the Indian economy and the Asian peers of the Indian subcontinent. So I believe that you are also taking notes of the overall aspects we are discussing in this economic forum. And I assure you that these notes would be of vital importance of embracing your overall knowledge set to enhance your knowledge skills about the economics